Hey, good afternoon, and thank you for joining this venture capital panel during Renaissance Capital's inaugural Nigeria Tech and Fintech Virtual Conference. Today's conversation will focus on how to address some of the friction areas with venture investing in Nigeria with a view to better understanding the sourcing and due diligence process of our speakers, where we're at in the funding and valuation cycle, how the ecosystem can help entrepreneurs navigate the rising regulatory risks and the intense competition for talent, and finally, how to create a viable exit process for venture investors on the continent. We are pleased to be joined today by Dr. Mobola Johnson, Senior Partner at Telecom Capital and Nigeria's former Minister of Communication Technology, Wale Ayeni, who is the Acting Global Head of Disruptive Technologies and Venture Capital Investments at the IFC, Iyolu Aboyeji, a General Partner at Future Africa, and last but by no means least, Benimkar, a Principal at Greenhouse Capital. I am Adesoji Sholanki, and I lead our Frontier and Africa-focused banks and FinTech equity research and venture investing teams. Thank you all for joining. Let me start off with a question to all of you. Can you each tell us about your funds, what you focus on by stage and funding amounts, and how you ended up doing venture investing in Nigeria in the first place? Let's start off with you, Dr. Johnson, then Inyi, Ruby, then Wale. So over to you, Dr. Johnson.
Thanks very much, Soji, and good afternoon, everybody. It's a pleasure to be here. So Telecom Capital is, we were founded in 1919 by current managing partner, Maurizio Ciao, very much focused on Europe and Israel and the US. That's where our first two funds are focused on. We invest in early stage companies, basically between $500,000. Our check size are between $500,000 and $10 million. We are sector agnostic, so any sector, as long as it's a large unserved market. And as I said, we do mostly sort of seed, Series A and Series B. We're currently investing out of our we've finished investing out of our $71 million fund. That's our first Africa fund. And we're currently raising a second fund also focused on Africa. How did we get to start investing in Africa? So my colleagues, Maurizio and Ido, in the Telecom 2, which was the second fund, made some sort of wildcard investments. Some of their shareholders agreement allowed them to do wildcard investments. And they invested in these two companies that were based in Europe, Movirtue and Upstream, but actually had all of their operations in Africa. They exited these two companies in 2014 fairly successfully. And it was then that they realized that something good must be happening in Africa. And Maurizio started coming to Nigeria, to Kenya, basically looking around and seeing what was happening. And that was where I met Maurizio. And it was at that point that we actually decided to raise a fully Africa-focused fund. And so that's how we started with our Tide 1 fund, which is fully deployed. And we're moving into our Tide 2 fund. So it's not just Nigeria-focused, it's actually Africa-focused. So that's how we got into venture in Africa. Quite coincidental, actually, but now more strategic.
Okay, sounds good. Thank you for that context. Inyi, over to you.
Sure. Thank you very much. My name is Inyi, and I am the managing partner at the Fund for Africa's Future. We are super early stage, a little bit earlier than pre-seed. We write $25,000 to $100,000 checks on our own, and then we have a syndicate that writes $100,000 checks all the way up to $500,000 checks. We tend to work with founders as the first check in their business. And kind of work very deeply with them. And this is because of our deeply operational background that led us to venture. I started building companies since 2010. In 2014, I got super lucky helping build Andela. And in 2015, I started to angel invest some of my income and proceeds from selling secondaries in Andela and companies. One of the companies that I invested in was Flutterwave, which ended up as a really, really good outcome. But we also invested in other companies along the way, Kobo 360, 54 Gene, and lately Move. And so it was that portfolio that gave us the returns to be able to then get more formal with our investing. And so, in 2020, during the pandemic, we started to do syndicates on AngelList. And we've kind of ramped up our investing from that alongside other. Good morning. I'm on TV. Hey, Faith. Sorry, Faith, can you help me? Sorry about that. So that was the funds that helped us to set up another one together with a few LPs, and we're raising right now that fund. We have a first close of $5 million, and then we're looking to raise a $10 million fund, and we're super excited about what's going on across the ecosystem. We focus primarily on 4 big areas: talent and IP. We focus on infrastructure, digital and physical infrastructure, mass media and consumer, and the environment, including agriculture. So that's all about us for now.
Okay. Yeah, thanks a lot, Ian. Over to you, Ruby. Could you give us some context around Greenhouse Capital and how you ended up doing venture investing?
Sure. Thanks for having me. Ruby here from Greenhouse. So I'll start with Greenhouse. I think Greenhouse really started as a little bit of an experiment. We today are a fintech and SME infrastructure focused investor. We tend to do average ticket sizes of something around 250 to 500K checks. And we're currently investing out of our second fund, which is a Pan-Africa and MENA-based fund. So MENA and Sub-Saharan Africa. Greenhouse, as I said, started off as a little bit of an experiment. So it was sort of spun out of the venture builder that the partners had built about a decade ago in Nigeria. It was really just a platform for them to be able to support other promising young Nigerian entrepreneurs. It was really also to be able to deploy and fill that sort of capital gap that existed, 6-7 years ago. Today, as I said, we're sort of a full-fledged platform. We run a combination of acceleration programs all the way through to also looking at things like debt, venture debt investing as well. And then on a personal perspective, I actually got contacted, or I got connected with Bumi and Kumi, who were the founders. I was super passionate about emerging markets in general. And I come from sort of a financial services and fintech background, typically working with large financial services and fintechs in the UK and the US. And then was really looking for something back in emerging markets. Got in contact with these guys, and 30 minutes of a conversation turned into about an hour and a half of us really gelling and talking about the ecosystem that Africa was starting to blossom into. And about 6 weeks after that, I ended up on a one-way flight to Lagos. So it was quite the experience, but I think really, really excited, as Ian and Dr. Johnson said. I think the ecosystem is just extremely exciting, and so lucky to be part of it.
Super, good to know. And Wale, over to you.
Thanks for the invitation to the panel here. It's a great thing that you guys are putting together for the ecosystem. But my name is Wale Ayeni. I'm with the IFC, and actually venture investing in the IFC started about 10 to 12 years ago. We've been doing that fairly well, mostly focused on India and China originally, but in the last 5 years, we've been looking at a lot more frontier markets, Africa, Middle East, Latin America, and Southeast Asia. Our program is more on the latest side of things. So we write checks from $5 to $25 million. We do both VC funds and direct investments into kind of companies as well. Fairly sector agnostic per se. So we look at all sectors, mostly from the Series B stage upwards. And then to your question about how started doing venture investing in Africa, I tell people you just need to jump on a plane and show up. So that's what I did about 5 years ago, and it's been a great ride since then. Thanks.
Sounds good. I like this jumping on the plane theme, which seems to be playing out along this panel. Okay. All right. Let me. I have questions for Ruby and Ian. Okay, so one of the areas we find that there's still significant friction in Africa is in the deal sourcing stage for venture deals. So how do you go about sourcing venture opportunities, and how has this process evolved over time? And what do you think needs to change to make this process more seamless? We can start off with you, Ian, then Ruby, you can come in with a comment.
Yeah. So when we first got into the venture space, what mattered the most to us was that we knew the founder. So we typically helped companies where the founder was either closely affiliated with us or that we knew the founder very well. Unfortunately, as time has gone on, sorry, can you hear the background? Okay, that's fair. Okay. So as we've grown, we've realized that, especially as a number of companies have grown, it's not the most sustainable way to continue to source. So we've kind of arrived at a 3-step process for sourcing within our firm. The first thing we do is we actually have, unlike most other firms, a research department. So led by a guy called Peter Quesada, who's probably one of the best venture researchers on the continent. And what Peter does for us is we look for market opportunities where there's clearly a need for a venture-backed solution, but there isn't anyone yet. So that helps us kind of create what we call a thesis around a specific sector. So when fintech, for example, the payments play in fintech had been already done, we started to recognize that we needed to start looking at other areas in fintech where perhaps there wasn't as much innovation. And one of those areas was wealth tech. So we wrote something we called the Wealth Thesis. Sorry, give me 1 second. Faith, take her now. So we started writing something we called the Wealth Thesis. And the Wealth Thesis helped us to basically identify all the companies that were helping Africans to build global businesses, helping companies to be able to helping individual consumers to be able to invest globally. So that was kind of one of the things that we did. The second step that we take is then we have a very, very dynamic system. We have a dynamic system for filtering deal flow that comes through the transform. But then one of the things that we try to do with that pipeline is to be useful to founders, even if we have to tell them no. So matching people to different sources of deal flow. We share our deal flow very openly with the rest of the eposystem. And that helps our deal flow get better because founders know that even if we don't invest, they'll still get to an investor who can actually invest. We've also kept our check sizes small so we can help founders validate a lot earlier. And this has helped us quite a bit in terms of identifying founders. Again, all done through the filter of our thesis research. And then the final step is we do have our own rubric for deciding what to actually invest in. And that allows us to identify adjacent opportunities in the businesses that we've already invested in. So for example, internally, we use something called the TD3 rubric called talent, data, design, and distribution. So we're thinking all the time about, how good is this talent? How much data do we know about this market? How is this product designed for scale? And how can we help the company get this product to consumers? But as we do that, we're also looking on the balance sheets of our companies to see the companies they've partnered with the best on doing this. And it's actually a huge source of our deal flow. So for example, we invested in a company that was in the mobility fintech space. We saw that the company was relying on this maintenance and parts partner, and then we invested in that partner. And so we tend to do quite a number of those types of things as well in order to improve our deal flow and sourcing.
Sounds good. And Ruby?
Yeah, I think there are some aspects that we probably echo from Ian as well. I think firstly, it's deal sourcing, I think, across the continent is almost like deal sourcing across like the UK, Vietnam, Australia, Germany all together, right? They're fundamentally so different. And so one of the things that I think has really as the ecosystem really broadens, I think what's really helped us is also looking at that kind of referral base, right? Whether it's from partners that we have currently in the ecosystem, whether that's on the corporate side, or even founders from our portfolio end up being incredible sources for deal flow as well. We often find that, especially in the early stage, a lot of founders who are, have this amazing idea, maybe they've built an MVP, they're actually looking at other founders in the ecosystem for either advice, for partnership, for testing their product. And often you'll find that they're working together in the early stages. And so we find that actually when we're working with our founders and we're speaking about, hey, what are some of the companies that you've seen? Which founders do you think have the same kind of ethos, mentality towards building as well? They embody kind of that experimentation, and they essentially want to essentially address problems. They're looking at kind of solving for the product or the market that they're operating in. And so we find that actually some of our portfolio founders end up getting the best deal flow, actually. And so they end up often referring back to Greenhouse. I think beyond that, I would say two other things that have been particularly interesting from a deal flow perspective. One is other fellow VCs. I know we've probably invested alongside all of the investors here on the call today. We are such a nascent and small ecosystem still, and we're still just on the cusp of pushing forward and growing. And I think most of us are probably on some kind of WhatsApp group together. And so often there's a lot of exchange of ideas and things like that as well. And I think beyond that, we also find, we look at kind of a rubric as well. So we look at things like, spending time with the founders and the team and how they kind of approach their problem solving. We look at things like how, based on kind of research and market trends, are they addressing a large enough market? Do we see opportunities to expand and change? And what do we see their market evolving into? And then I think we also really, really look at things like how can we add that value to catalyze some of that change as well. So things like relationships that we might have, whether there's synergy across the portfolio. We really don't operate under, I guess, a scarcity mentality, but rather a more abundance mentality, where it's someone solving a very similar problem in Kenya may be able to actually work with someone solving the same kind of problem in Nigeria. And so we also look at kind of cross-portfolio synergy as well.
Sounds good. Michelle, I'll be touching base with you about this exclusive WhatsApp group later on.
It's not exclusive. There's everybody is on it.
All right, cool. Okay, let me come now to Dr. Johnson and Wale. So for your funds, what are the top things you look out for when you're assessing venture investment opportunities? And what does the due diligence process look like in the venture space for your funds? Perhaps you can share one example that is top of mind for you, just to bring the points home for the audience. We can start off with you, Dr. Johnson, and Wale, you can chip in.
Thanks, Soji. For us, we look for, I would say, 4 top things. First of all, we look at the market in terms of, is this a big underserved market? Is it a market that can be very well served with technology enablement? Is it a market that is growing and will continue to grow and will deliver scale? The second thing we look at is really the company. There's a problem in the market. What is the problem that the company is trying to solve? How are they trying to solve the problem? What are the business models that they're deploying? Are they innovative? Are they creative? Are they just copying? So we look at the company, and how it's trying to solve the problem in the market, and how does it compare with similar companies or with competitors in the marketplace. Then we look at the entrepreneur. Is this entrepreneur, is he a visionary, or she, as the case may be, a visionary? How good have they been at building a team? How good have they been at executing? Do they listen? Will they listen? Will they learn from other, will they work well? Is there sort of good chemistry between us and them, even as we do the due diligence? And I think finally, the last thing we look at after all these things is actually the investment itself, because, is this an investment that will deliver a good return, depending on where you're entering? What are the multiples in the marketplace? How do they compare? Can you deliver those multiples in the time that you're going to invest? So those are the 4 things that we look at. And you find that, there's several combinations of these things which will help you to make an investment decision. You could have great market, great company, great entrepreneur, but the investment mechanics just don't make any sense for you in terms of the return. You could have a great market and and an entrepreneur that really hasn't thought through how he's going to solve that problem on a long-term basis. So there are various permutations of this and the way that we look at companies, but really around those 4 major buckets. I would say in terms of our business due diligence, what we do is, again, before we decide to invest, it's a case of really just trying to understand the company better, spending a lot of time with the entrepreneur, understanding his thinking, his philosophy, why did he start the company, how is he building his team, spending time with the consumers of the product or service that the company is building, and of course spending time with the company itself, the team that the entrepreneur has built. I think one of the most interesting, when we do the business due diligence, one of the most interesting that I have ever done up to now is we invested in Pula. Pula is insurance, fintech, but it's also agri-tech. It's providing insurance to small-scale farmers across Africa. And of course, who are the consumers of Pula? It really is the small-scale farmer in Africa. And they're not in Victoria Island or Ikoyi. They are in some rural parts of Nigeria. And so we had to go visit some of the farmers to see what the farms are like. And we went to, it was Ilaru, which I thought was just literally down the road in Abeokuta. But no, this was a different Ilaru, which was it was a border town between Abeokuta and Benin Republic. And this was a sort of 14-hour round trip in a car, with bad roads and everything. But I think the best thing about it, just, talking to consumers, going out there, speaking to the farmers themselves, there's a cooperative of farmers, and seeing, one of the biggest use cases of Pula insurance, which was a maize, as far as the eye could see in this community, the maize crop had failed because there were no rains. So as far as the eye could see, you could see the dried up maize stalks. You could then really begin to understand the impact that Pula would have from a commercial perspective, providing insurance to these small farmers, making them less vulnerable, but doing it at scale. I mean, they're doing 4.5 million farmers in Nigeria, Kenya, Zambia, but this is something that scales to other. You could easily see the scale of this company because it can scale to sort of Latin America and Southeast Asia. So that's one anecdote that I have from doing business due diligence, but really it's something that we think very carefully about it, speaking to the consumers, the entrepreneur. We probably have spent about 6 months or so with an entrepreneur before we decide to invest, because we're tracking them, and Ruby has said, the deal flow, the pipeline. Just speaking to entrepreneurs all the time and deciding that when you're going to invest, it takes a lot of time. It's not just a sort of 2-week or 1 month process, but just talking to entrepreneurs, the consumers, and also actually doing the due diligence. We actually speak to other VCs, particularly those ones that have invested, that are current investors in the company, but also people that are in the space. If it's fintech, you want to talk to some of the VCs that are fintech only investors. So that's the way that we do our due diligence. I'll stop now.
That's really good to hear, particularly around how thorough the process, even at the venture stages, because many times you think, okay, early stage companies, people are just writing checks and getting things done. But good to know that there's a lot of kicking the tires that actually happens in the back end. Wale, over to you. What are your thoughts on the question?
Yeah, thanks for asking me the questions about due diligence, because we get that a lot in the IFC, because there's this rumor that we're heavy-handed when we do due diligence, but it's partly right and partly incorrect. I do think that kind of on the space that we play, you have to do your DD quite well, and kind of how Omobola has said, our approach is kind of basically similar, and the kind of things you do, right? So we just try to figure out whether the product, the team, and the market all match, right? And it depends on what emphasis you put on what leg, depending on the stage of the company, right? So if the company is super early stage or pre-seed, there's no need to review the code or have due diligence around that. You're really backing the entrepreneur. But at the stage where we play Series B or C, there's kind of more data that you can chew around and decide. The way we like to do it, at least in the group on my team, is we try to, even before we approach entrepreneurs, to have a view on the market. So whatever the sector is, whether that's financial services, whether that's e-logistics, whether that's, B2B marketplaces, we already have a thesis around that particular market, a thesis around Africa, but how that plays globally. So that makes it easier for us to identify people that we want to work with. And part of that identification is both sides, right? It's not just figuring out what entrepreneurs fit into what we want to invest in, but also assessing ourselves and figuring out where we can add value. Because there's not always, it's not always 100% that there's a fit, because we wouldn't invest in anything where we don't think within the organization we can add value, because we'll be just giving money and not adding enough value. So we do internal DD on ourselves as well to say, this sector we can actually add value, this sector we cannot add value. So there's no point investing in sectors where we cannot add value. So the DD process, I'll say, on our end is both ways. But from the approach that it's kind of similar in VC, we have a vision on the future, we have a vision on the sector, and then we're trying to figure out who is tackling problems in that sector where there's a compatibility between both us and them and what we want to do and what they want to achieve, and we can help them achieve that faster. But from a DD perspective, I tell folks, we have to do DD. We're not a firm that can invest without DD. So we always do DD, but we try to at least have done the market research before we actually approach the entrepreneur.
Okay, sounds good. Now I want to move on to some important topics for Nigeria nowadays. So currency and regulatory risks, which we know are some of the more significant risks that an investor into Nigeria needs to think about very seriously for Nigeria investing in particular. So first of all, how do you think about these risks when looking to make an investment in Nigeria? And secondly, how should tech companies in Nigeria navigate this landscape better going forward? So I would like to get your comments on this, and probably Wale and Dr. Johnson, if you have any views on the currency or regulatory aspect of this question. So we can kick off with you.
Sure. I think regulation is very important part of the business, but I think sometimes we may be putting too much emphasis on it, perhaps at the cost of innovation. My sense is that if something is a product that consumers really want, and there's real value and solving a big problem, it's oftentimes the role of the investor to think about what the appropriate regulatory framework or intervention should look like. At our firm, the way we deal with this problem often is that once we are aware that the product is actually going to solve a problem, we take our time to really design what the regulatory framework looks like. And the way that works typically is to partner with already existing players who are regulated to do that business, and make them our interfaces to the regulatory bodies, because small startups are not equipped and quite frankly should not be equipped to handle regulatory affairs issues. You have to do those types of interventions at scale. So it's a huge distraction for a startup founder at the stage that we invest in to be thinking about regulators, and we don't encourage them to do so. However, at the same time, there's a real role for a broader ecosystem conversation around regulation that probably has to be led by larger companies and leaders, because there's work to be done in that respect, in terms of putting together a framework that doesn't stifle innovation at the earlier stages. But my point of view of regulation in general is just let innovation lead, and your partners can handle that are much larger than you and understand more of the interests can handle the regulation.
Okay, all right. I would like to know what what Wale or Dr. Johnson thinks around this question.
I can definitely chime in. I think regulation is not something that is unique to Nigeria or Africa. I mean, all all countries all over the world have issues with regulators, but it's really around when do the regulators engage. So I think I'm of the view, and it's a view that we've proposed multiple times, that you should let innovation lead, but it's also a very fair point that consumers need to be protected at scale. So the challenging thing is when innovation is starting to go very, very quickly, when do the regulators come in? Because the role of the regulators is really not to stifle innovation, it's really to protect the end user, the consumer. But sometimes it could get heavy-handed at the earlier stage. So one of the approaches that we've used is actually engagement, because I don't think there's any regulator there that is looking to stifle innovation. Most times it comes from a position of not knowing fully what's going on and a position of fear of protecting the consumer. So our advice to everybody in the ecosystem, and we try to foster this a lot, is that there needs to be a lot more engagement where people can come and openly discuss, this is what we're doing. It's not that we're there to be a pain point for the consumer. It's actually the contrary, that innovation actually helps improve access to consumers. It's just how do you do it in a framework that is inclusive and it's protective. And I think there's no two ways around it, but to fully engage with the regulators to tell them in simple terms kind of what innovation people are trying to do. And then to the other point of your question around currencies, right? Because it is a fact of life in Africa that most of this currency gets devalued every 5 years. And part of the way you have to approach it, in my view, as a VC practitioner on the continent, you have to diversify, and you got to find ways to diversify quickly, where you don't want to be beholden to just one single country's currency. Because when you look at the historical charts, it's not quite encouraging. And we've seen people that out of, not that they didn't work hard, they've actually grown in local currency terms. But when you convert it into the dollars, it could become flat year over year due to no fault of theirs. And the approach that we advise a lot of startups is that you have to find ways to diversify your revenue stream actually quicker and faster than if you were like doing this in the US, because there's a real risk of currency issues in any country in Africa at any one time. The good thing though is that all these currencies are not going to go down at the same point, So once you're diversified, you kind of give yourself some protection there.
So if I could just add, because I had the benefit of supervising a regulator for 4 years when I was Minister of ICT. And I think one thing, I completely agree with Wale around, what do we need to do? It's about engagement, but it's also about collaboration. Because when you look at the regulator's mindset is one of, trying to create and enable an environment, a level playing field for all the players in the field, but also to a certain extent, of course, consumer protection. So if you look at the regulator's perspective and the reason for being around that, when innovation begins to go faster than they can understand, and in lacking that understanding, it's about how do other competitors in the field play, given that this is innovative, everything's innovating so fast. And so when they come up with those policies that don't seem to make any sense, it's really around a lack of understanding, a lack of awareness, and really just trying to be able to control the pace at which things go so that, you can actually regulate properly. So I think, one thing I always said, and which I did, when I was in government, was really around engagement with the industry. You've got to speak with the industry. Some of the things that were tried was, getting people from industry, in NCC in particular, people in industry to work at the regulators and vice versa. So you also understand how you're thinking. So I think that engagement and collaboration is absolutely critical. And I think that's what we need to do for some of the issues that we're experiencing in the space, in some space in Nigeria around regulation. It really is very much around engagement, collaboration, and making sure that both the regulators and the players in the industry understand each other and understand the perspectives from which they're both coming from.
Yeah. So that's good to hear. We actually had one of the heads of exchange regulations from the SEC join the panel today, and it was quite encouraging to hear about how open they seem to be, particularly with respect to engaging with the ecosystem. He was also talking about, some of the sandbox ideas that they've come up with as SEC. But I think certainly, as you've all mentioned, there's more room for engagement, particularly with the regulators, because our house view is that certainly Nigeria is facing a currency situation, right? Which certainly means that the conversations around that facilitates FPI into the country needs to be more encouraging, okay? Because sometimes some of these headlines can be discouraging for foreign investors. Okay, so let me come now to Ruby and Wale, and this question is more around where we're at in the environment. So in public markets, we often say that when frontier markets get to top of mind for foreign investors, it can be seen as an indicator of where we're at in the cycle. So what is your assessment of the current funding environment and valuations of African tech companies? And what do you make of the risk of flat or down rounds as even some zero revenue companies are being valued at tens of millions of dollars from the get-go? So probably, Ruby, you can kick off, and it'd be good to hear what you think, Wale.
Okay, in terms of where valuations are at, I think it's actually a very real risk. I don't think there's any magic wand necessarily that allows you to raise a load of money just off of fantastic storytelling. And then, suddenly you can continue raising and raising and raising, right? I think the more you raise and the more money that you end up bringing into your business, the more you're responsible to also follow through with the commitments that you've made to those investors, right? And I think there is a lot of importance around, being able to be focused, building on a sustainable business, playing that long game, being able to have kind of sustainable growth that you can actually that you can manage over time. And so I think the risk is very real. We've seen it before. So I think in terms of things like valuation cycles, they are higher than we've experienced in the past 3 to 5 years. There's a lot more international capital coming in, but there's also a lot more capital flowing in, even from local investors as well. And so I think things are starting to just heat up in general. Where I think international funding also has kind of had an impact, it's very similar to kind of that regulatory issue that you guys just talked about, right? Where sometimes there's a bit of a lack of understanding of what's happening on the ground. I think Mrs. Johnson basically had mentioned this before, where actually you find out a lot about the opportunities while you're on the ground and speaking to entrepreneurs, versus kind of saying, hey, as an international investor, I've seen someone solve this problem in LATAM or in Mexico or in India before. It must apply, and we should just be able to mold it and do the same in Africa. I'm not sure if that strategy really works, especially in that early stage. And so having kind of tens of millions of dollars pumped in at the early stage may actually end up being kind of negatively impacting the way you can raise in future rounds as well. But I also think that there is a place for that international funding, right? It creates a lot more interest in the market. It creates kind of availability of capital for the multiple entrepreneurs that may not necessarily get access to capital from local funders either. And I also think international capital brings a lot of other experience that have sort of been around for decades, especially as companies go into that sort of growth stage, when they're thinking about expanding, when the challenges are a little bit different. I think international capital has a really strong place in that sort of stage. But I think, Wale, I'm also curious to hear what you have to say here, and also Ian being on the opposite side of the of that of that deal as well.
Yeah, I can chime in here, and I'll start with just a rebuttal to what Soji just said about public markets, thinking that when frontier markets get attention, it's frothy. Maybe public markets should look at frontier markets as the future. So I think we talk a lot more about that. I do think the future of tech is actually frontier markets. It's kind of where the population is. It's kind of where the numbers actually are. So I do think frontier markets getting attention, it's kind of overdue. It's not There's been a lot of attention in the West. There's a lot of money in the West. So I'm actually, when people say valuations are high in Africa, the truth is that valuations are high everywhere. The only thing that changed this time is Africa is participating in the fraud. It's not that. So the question when I look at it is, 100% I agree that valuations are high historically in tech. There's a lot of money in tech right now globally. So across the spectrum, across regions, valuations are high, not just in Africa. And in tech is cyclical, right? So there's high times and there's down times. And my sense is that we're kind of in a high period right now where valuations are high, and even in the high times or down times, good companies are being created, right? So the question is whether it's a downturn or high turn, there are good companies being created today. There are good companies going to be created tomorrow. I think Google was created during the .com bubble as well, right? So my answer to that is just that valuations are high, but the people that should be more worried about it is kind of the investors, right? It's not really the founders' issue. The way I see it is that this is a good time where founders are getting money to experiment. A bunch of these things are going to fail. That's just the honest truth. But we're in the business of innovation. We're in the business of people trying things out. People are getting money to try things out. People are going to, a lot of things are going to fail. But as an investor, I look at it and say, yes, valuations are high. So what can I do? The only thing I can do is maintain investor discipline, right? So you need to understand what you invest in, why you invest, because if you invest in something that becomes a market leader, that becomes the biggest thing that was created or one of the biggest things that's created, you'll still make your money back, given that most of these valuations that are high are still kind of at the early stages, right? So, however, if you invest in things that don't pan out, obviously you're going to get down rounds, right? So I do think, the question is yes, but the concern is more for investors and how investors invest, and the risk is actually to investors. But for the founders, it's actually a good time to start a company, and it's a cyclical thing because you need companies to start and then they experiment. Some will fail, some will do well. So we see the valuation being, everybody is raising at various astronomical valuations right now. Some of those things obviously are going to fail, but some of those things are going to be extraordinary successes that even if you participate, if you decide not to participate because of the valuation, you might kick yourself in the foot. So I just think what is happening in the period of high valuation, it makes an investor's work a lot more harder, right? Because you need to decide that you're choosing, and that is our problem to solve, not the founder's problem to worry about. People need to go out and raise money and build their companies. And then investors need to, in my view, be disciplined and figure out, if this thing is going to be the next big thing, then whatever you pay is okay. But if it doesn't, then obviously there's going to be a down round in the future. And the people that are going to, people that, I don't know how many, we've not had enough cycles in Africa to really see how people behave in down rounds, but it's also people are gonna go through a down round where it would be painful to a bunch of folks. But I do think right now I think the encouragement is, the good thing about high valuation is that it encourages people to go start things, so, and we're in the business of innovation, so more people are coming in to start things, and then investors will figure out what to invest in or not.
Cool. Ian, the baton was thrown to you, so we need to hear your comments on this.
I think my views on this are very widely acknowledged. I think first of all, you have to go back to fundamentals when you're having a conversation about valuation. I think one thing that we're ignoring in this conversation is that valuations have always been a function of what the market is worth, not what the business is worth, because it's a bet on the future. And the reality is that COVID blew up the market size for tech and innovation. blew up the market for tech and innovation, because all of a sudden you have all these number of people who are kind of glued to their seats, to their phones, sorry, and there's internet coverage, and there's all this infrastructure that enables connection over the internet, and this is pretty important to note. So the market TAM has grown exponentially, and furthermore, when you look at valuations around the world and multiples, Africa is still very, very low, right? Even with the same traction, you're not comparing to your India peers, you're not comparing to your Philippines peers, you're not comparing to definitely not comparing to your US peers. So I think it's a fundamental error in judgment to look at valuations in isolation. It's a global market, even more so than it used to be pre-COVID. Businesses are now able to pursue customers around the world. Businesses are now able to leverage and execute with talent from all over the world. Some of the costs of building a company have gone up because of COVID, and some costs have come down. And so as a result, it's very important for us to think in context as far as these things are concerned, so that we don't make the wrong valuation judgment. Thank you.
Yeah, thank you. Thank you for your comment, E. I want to come now to you, Omobaf, and this is a question around FX versus local currency investing. So one thing about the funding environment is that the deals we often hear announced are mostly done or announced in foreign currency for companies that are earning local currency revenues. So what scope exists to get more local currency funding to back these companies? And how do you think about the pros and cons one way or the other?
Yeah, look, it's a great question about trying to have local currency capital. When you say what scope exists, is actually, to be honest, it's not that great, because, and I speak for Nigeria now, not the whole of Africa, but I suspect you can extrapolate to the whole of Africa. When you look at, people have alternatives, people have choices, whether you put your money in venture, or whether you put your money in real estate, or whether you put your money in government bonds and bills, or whatever it is. And I think that's the real challenge that we have in Nigeria right now. The returns on, at least in the last 3 to 5 years, on treasury bills and government bonds and real estate have actually been quite high. And they're quite, you can do 90 days, 180 days. It's short term, and you get your money back and you get interest on top of it. But when you're talking about raising local capital for venture, you're looking at being able to put money away for 3 to 5 years with no guarantee of a return. And so when people are trying to raise, the asset managers that have tried to raise local capital, the question they kind of get asked is, what's the guarantee? And as we all know, there is no guarantee when you're doing venture capital. Even when you have you give them a hurdle rate, that hurdle rate makes sense within the context of where they can get investments, where they can get returns in other alternative investments, whether it is real estate or bills or bonds or whatever it is. So I think that there are efforts being made right now to raise local currency debt, but the fact of the matter is that for many of the people, local currency equity, but many of the people that can actually give that equity, the big PFAs, the big asset managers, these are people that really are not incentivized to do so. You're not incentivized to risk anybody's money to get a higher return. You're incentivized to return money month on month, year on year. So I think it's still a little bit way out, but I do know there are asset managers that are trying to raise local currency debt. They're trying to do it in innovative ways by having shorter cycles, and all of that. But basically, I think that it needs to be done. But there are some challenges that we're going to face along the way. And like I said, it's around what the alternatives are. But definitely needs to be done because, I think it was Wale that made the point earlier that, the way that you diversify the currency risk, and there's a big currency risk in Nigeria. When we invested in companies, you're doing at 360 to 1. Now we're looking at, budgets for, or trajectories for 2023 and beyond. You're looking at anything from 500 to 550. So basically just running, you have to do like 3-4x returns to make any sort of sense. So there is definitely a need for it, because if you're earning local currency, you should be funded with local currency. But I think that it's still a little bit way out. And it requires, again, as we said, a lot of awareness creation, understanding of what what venture capital or private equity capital does, how it operates, particularly with some of the bigger asset and fund managers. So there's a process, and all I would say is that based on what I know in the market, the process has started, but it's going to be quite a while before we see sort of big billion naira or several billion naira funds available for venture companies.
Okay, sounds good. Thank you, Dr. Johnson. Look, I think it's important because there's a number of domestic investors who I presume would like to get more actively involved in the venture space, and I'd like to hear what he has to say because.
Sorry.
Okay.
Sorry, if I could just want, there is this, as we just talked about valuations. So there's this excitement about venture because everybody sees this very high valuation and everybody wants to get into, one venture company or another. But I think that, when it's not a case of if, when the market turns, I think you'll find this capital would leave very quickly. And when they can't leave, it really is going to be a problem for people that have raised local debt to raise subsequent funds. It's going to be a big, big problem for them because they can't get the money back. They've lost it, but they will not be able to raise, subsequent funds. Sorry, Ian.
Ian, you're on mute. You want to unmute yourself.
Sorry. Yeah. So again, on the local Naira fund, I think it's important to point, there's a role for local currency capital in the venture ecosystem. But it's important to understand what you're investing in. You're investing in intellectual capital, right? For the most part, you're investing in software for the most part, or hardware, and you're investing in Pan-African scale. If you really want to get the maximum returns, no one has ever built $1 billion business by sitting in Nigeria, at least $1 billion tech business. Almost every unicorn has had to have Pan-African design to be able to reach their true potential. And I think it's important to keep that in mind because when we have a conversation about local currency debt, I think we got to understand the currency itself and its own macros are not stable, right? So if you're going to invest in a company for 18 months, you're going to put 100 million naira into a company. If 100 million naira can within 18 months be devalued by 30%, that creates all sorts of other problems for the business that are independent of what the investor and the business can do. So I would say, and more so, your goal should not be to maintain Naira revenues as a large percentage of your business. Your goal should be to transform Naira revenues into growth, right? By hiring local staff, by continually pushing the limits on growth with Naira revenues, using it to buy local ads, using it to buy local growth factors, and so on and so forth, incentivize your customers. So I would say from a financial architecture point of view, I think if at any point in time local currency became the currency for our venture industry, it will die. That's my belief. I think local currency can at best be debt, right? That can be used and anchored against dollar equity assets. And that's more secure for the ecosystem. And I just think that if you want to invest in IP that can go global, you got to bring the currency of global markets to play, which is USD, so that you're getting a fair value for your money. Because I would never advise a founder to take money that can be less within the period of time he's expected to spend it. Because we can't go back to the investor and say, you were supposed to invest $250,000, now it's $100,000, and then, that it won't work. So that was the point I wanted to make.
Okay, thanks a lot, Ian. And I know that Wale has a comment on this question, but as you think of your response, I want you to answer an additional question to that as well, which is around exits. So the question is more around what room exists to create a secondary market for existing investments in the venture space, given the low number of tangible exits on the continent. We heard today that the Nigerian Stock Exchange, they are looking to create a platform to facilitate this type of transactions. But what options do you think exist to smoothing the exit process for venture investments? So that question, in addition to your thoughts around local currency funding.
Thanks for that. I'm actually passionate about the local currency topic itself. And I do think from what you said and what Mobile said, both right. The two things I'll add is like from an equity perspective, given that you're dealing with global investors, the currency of equity globally is US dollars. So I don't think there's any room for people to say, okay, we'll invest in Naira in equity in things that are venture-esque. However, if anybody wants to start a local currency fund in Africa, they should really, really look at venture debt. They will clean the market out, because I do think there's a huge opportunity for venture debt in local currency across Africa that a lot of startup needs. There's a huge demand for it. So if you want to start that kind of fund, even us as an organization will happily back something like that, because it's a huge need that is actually there, because you can't, the currency of most of the startups is local, so their working capital needs are local as well. So if people think about creating local currency, they should really think about venture debt, because there's a debt component to it, but there's also an equity kicker that you can actually get upside in dollars as well on your local currency investment. I just think it's a huge opportunity that people should take a look at. But for your question around kind of exits and secondary markets, I think those things form as the ecosystem develop. Secondary markets are a function of the quality of startups that you have. So if a startup is doing well and there are more investors than equity, than new equity that is supposed to be issued, you will naturally get secondary markets. And we're starting to see that even in the early stages as well. There's secondary deals that are going on right now in Africa in early stage companies right now. So I know people want to create an infrastructure before the market is there, but I do think let the market develop, let the startups start issuing secondaries, then you can create like a market to facilitate it. But as I see today, I don't think if you have a great startup in Africa, that there are more investors than new issuance of equity. I've not seen people being challenged not to do secondary sales. I do know a bunch of secondary sales have already happened on the continent as we speak right now.
Okay. Thanks a lot, Wale. That was very helpful. I want to ask this question to you, Ruby, which is more around something we learned, what we heard about very, very often when we were in Lagos a few months back. And this is around the competition for talent. Okay, so how challenging is the competition for talent? When I say talent, I mean, particularly software engineering talent. What we heard a lot about was, big tech poaching talent from Nigeria, and other well-funded tech companies who are increasingly poaching, talent from each other, or even from the banks. So how are you or your companies addressing this challenge, or even as an ecosystem? It'd be good to hear what you think, Ruby.
Yeah, it's definitely something that we found a lot of our portfolio companies have talked about. I think there are a couple of things that, and it's not just software engineering talent. I think there's a lot of other talent gaps as well that we found exist. I think we've been engaging quite extensively with schools from the onset. So really trying to pull some of the younger kind of talent into, some of our programs and acceleration programs that we have in-house. But also just looking for either two things. I think the funding aspect actually supports some of the talent. I think there's a lot of talent that ends up moving abroad and doesn't necessarily come back. So actually some of the kind of, ability to raise equals the ability to pay your talent, equals the ability for sort of going into brain draining as early as possible. So in working with kind of some of the institutions that are actually solving for this, that's kind of how we've done it. Obviously, there are companies like, Andela, there are companies that are solving for it as well. But it's really just around being able to provide sort of training grounds, being able to provide work with really, really large institutions or universities, and then bring them through the entire journey. That's kind of where we've seen most success.
Okay, thanks, Ruby. And this is my very last question to all of you. So it's a very quick fire question, which is, First of all, what aspects of tech or fintech venture investing are you most excited about in Nigeria? And secondly, which other African markets are you paying the most attention to today? So let's start off with you, Dr. Johnson, then Wale, then Ruby, then E.
I think very quickly for us, it's really fintechs that are providing infrastructure, or the terminology is now the rails for other fintech and other companies to do things using their services. For me, that's for us. That's really where we're focused on. In terms of other markets that we're looking at, Nigeria is obviously one of the most compelling markets for fintech. I would say Egypt as well, because of the size of the population and the penetration of financial services. Those would be the two, and probably other smaller countries around West Africa. East Africa is tough because of M-Pesa and the ubiquity of M-Pesa and what they've done. So I'd say those are probably the markets: North Africa and Nigeria, plus other countries in West Africa.
Okay.
Yeah, on our part, on kind of fintech, fintech is a great sector, but what we're actually spending a lot of time with people that are starting to create apps that can capture the imagination of the consumer and let them reside in there. So while fintech might be the enabling factor initially, it's more about the long-term goal or are you creating an app that becomes part of a consumer's daily need and necessity. And that includes things like embedded finance, things like how can you super apps and all of those kind of plays, because we do think the infrastructure is being built and people have started to do that, but there are other ways where you capture the consumer while the fintech kind of rides underneath that. So we're spending a bunch of time on that because our approach, we're trying to build things that are very, very big and large scale and pan-African in nature. From kind of where we sit, we don't focus on one country per se. I think for anything we do, it has to be Pan-African. You might start in Nigeria, or Kenya, or Egypt, but you have to have aspirations of either being Pan-African or actually being global as well. So we don't, and we've seen most of the startups, it doesn't really matter where they start, they mostly go across Africa very, very quickly. So we don't put kind of country demarcations on them.
Okay. And Ruby?
Yeah, I think for us, definitely within the sort of fintech infrastructure space, but really around, where are they building connectivity? So we see massive opportunities and really interesting startups coming up in the SME infrastructure space as well. So how do you start catalyzing the shift of offline to online for SMEs? What does that look like throughout the entire value chain as well? How do you enable things like cross-border trade? How do you enable, digital invoicing and receipts management? How do you enable digital inventory management? So laying that ground for things like e-commerce, obviously backed by things like fintech infrastructure, embedded finance as well, I said as well. That's probably some of the most exciting sectors. In terms of region, I would say our core market tends to be Nigeria, but I really think there's some interesting opportunities coming up in even places like Francophone West Africa. We've seen more and more companies come up in the region that are solving for just incredibly large problems with really strong talent and entrepreneurs backing them. And then another area that we're starting to dabble into is across the North African region. So even countries like Ethiopia are quite interesting. Countries like Egypt, as mentioned before. Also, just across that sort of, we've seen, the first company come out of Morocco that's now entered YC. So we're starting to really pay attention to that region as well.
And Ian, you're on mute.
Yeah, so for us, we're really looking deeply at the intersection between decentralized finance, the Internet of Things, and asset-backed finance. We see quite a lot of physical assets as like the seeds of value, and we're looking at how we can create economies, as we call them, where we can put these productive assets to use while leveraging the asset itself as a security that backs it, and then stopgap with securitization that comes from blockchain, so that in real time we're creating higher quality lending assets that can be traded globally in a new kind of finance ecosystem. So we've done quite a bit in this area with Move, where we're looking now at the parts business, and we're looking at other kinds of finance in this area, mortgages, the really hard stuff. In terms of markets, we're learning a lot from Nigeria as the market continues to be dynamic. So it remains our primary focus for investment. But the other market that we're learning as much as we can about is Francophone Africa. We think that's the prize for the next generation of billion-dollar companies. And we think like everywhere else is a bit too busy for a small player like us. We're investing personal funds. We don't have hundreds of thousands of dollars. So we have to be very smart and go where no one else will go.
Okay, sounds good. Look, this has been a really insightful conversation, and I would like to thank you, our panelists, for your time and your insights, and even you, the audience, for listening in. I hope you continue to enjoy the remainder of the conference today. Thank you very much and take care. Bye.